Hi, personal finance gang. Welcome to another week of social distancing. I hope you're doing well or as well as can be expected given the current mess. But from here on begins a new part of our personal finance adventure. What we'll be talking about for the rest of the semester is investments. So we're going to be seeing some quick topics that I would cover in my full semester term of investments. We're going to see some of the high points from that. So what we'll talk about today are some just basic investment considerations. We're going to introduce a few of the things that we'll be talking about in more detail later on. So we're going to introduce stocks, bonds, we'll introduce mutual funds and ETFs, and then we'll see all of those in more detail in later topics. Before we get to those additional topics next week and beyond, we're going to talk about primary and secondary markets. What are those? What do they mean to us? We'll talk about what you need to do to buy and sell stock, and then we'll finish up this section by talking a little bit about asset allocation. What I'm going to try to do starting now with these little videos is try to make them roughly 15 minutes or so. So I'm going to try to stop more often and make these a little bit shorter. I actually had some software issues and I'm redoing pretty much all of this chapter after my software crashed and burned. So I've practiced this mostly already. All right, so let's first define what we mean by an investment. So what is an investment? What does that mean to us? So with an investment, what you're doing, an investment is basically you put up money in the hopes of making more money. So putting your money in your bank account is an investment. You put your money in the bank account hoping to earn, well, whatever rate your bank pays. Maybe you've got one paying 1.6%. That's a good deal now. Maybe you've got one paying 0.16%. Maybe you should be shopping around more. So putting your money in a savings account, you're putting money in there hoping to get a payoff for doing that. Buying stock, we'll talk about what that means later on. That's an investment. You put money in the stock market, you expect to get a payoff for that money you invest. So maybe you buy Apple computer stock and you're hoping to do better by having that investment. In my little definition I have on the screen here, you put money up with the expectation of getting additional money. That word expectation is a clue that, hey, any investment you make has some level of risk associated with it. So your benefit or payout or your future benefit is uncertain. So even with a investment in a bank account, you're guaranteed, say, your 1.6% for this quarter. But when you get that 1.6%, the value of that may not be as certain as you expected. So inflation may end up being higher than you thought, so you don't have as much purchasing power as you thought, even if your payout is guaranteed. It's even worse with an investment in the stock market. You put your money in the stock market, you're hoping to get a 10% return. You may lose 20% or more, such as we're seeing in the market right now, or you may make a bundle. And inflation may end up being different than you expected. All sorts of things can happen. So your payout, your what you ultimately earn is uncertain with any investment. Return, that's just your payoff, your profit from an investment. So your return on a savings, putting your money in a savings account might be that 1.6%, or it might be 0.16%. You put money in the stock market, you may get the stock price to go up, you may get a cash payment from the stock. We'll talk about what those are later on. So, but Return is just your profit or payoff from an investment that you make. Now, most investors, and probably most of you, would like more return. So I said, geez, would you rather have 5% payoff for investing in Apple stock, or would you rather have a 25% return for investing in Apple stock? Hey, we'd all go, give me that 25%. That sounds better. But on the flip side, we dislike risk, so we prefer less risk. So given a choice between, hey, 50% chance you make that 25%, 50% chance you lose 25%, we like certainty more. That's pretty risky, 50-50. So we prefer less of that risk type stuff. So return is good, risk, uncertainty is bad. We'd rather have a guaranteed payout. But guaranteed payouts, you can get a guaranteed payment from the U.S. government. So if you buy U.S. Treasury bills or Treasury bonds, those come with very low risk, but they also come with very low return. So if you're going to take on more risk, or if you want a higher return, you have to take more risk. So you are not going to get a 10% return right now by putting your money in a savings account. What you get in a savings account is very low risk, very low return. If you want the higher expected payout, again, expected payout or expected return from investing in the stock market, you've got to take on more risk. So suppose I gave you a choice of buying bonds, and we'll talk about this more later on, but when you buy a bond, you are lending money. So suppose you could lend the U.S. government money, or you could lend money to RiskyStartup.com, and both places were promising to pay you 3%. So the U.S. government, I'm pretty darn confident they'll come up with enough money to pay me my 3% and give me my money back. RiskyStartup.com could go out of business and not have enough money to pay me. So would I lend them money at 3% when I could also lend the government money at 3%? No way. So what's it going to take to get me to invest in RiskyStartup.com bonds or to lend them money? Well, I don't know, but it's definitely going to be something more than the rate that the U.S. government is paying, because RiskyStartup.com definitely has more risk. Investors putting their money in them would demand a higher return. Now here's the legalese part of my lecture here. If you take on more risk, you have a higher required return, a higher expected return. The actual return you get may vary. That's why we call it risk. So you may put your money in Apple stock thinking, hey, I'm going to make 10% this year. That's what it should give me based on its level of risk. And, well, you may end up losing 20%. So this is really, really evident in the market right now. The market is, at one point, was down about 34% from its high in February. It's bounced back up, and it's probably still down about 23% or 20-some% right now from its high in February. So remember, we said the stock market isn't a good place to put your rainy day funds or your tuition for next semester. That's why. More on that coming up. Now, these are some terms I'm going to introduce. We'll see a whole section on stock and a brief section on bonds starting next week. So we'll talk about what common stock is, what bonds are. Then we'll also talk about exchange traded funds and mutual funds. So we'll have ETFs is short for exchange traded funds. We're going to just give you a quick definition of these, and then we'll see a lot more detail on ETFs and mutual funds in a later topic, and a lot more detail on both stocks and bonds. But for individual investors, mutual funds and or ETFs are a good place to start. And these are actually a good place for more experienced investors as well. But we need to talk about stock and bonds so you know a little bit about the basics of the types, the key types of securities that you'll find in most mutual funds and ETFs. So with that, a company, companies, why do they sell stock? Why do they sell bonds? Basically, they need money to open up or to expand or, develop in new areas. So they need funding. And by issuing stock and selling bonds or borrowing money are the key ways that companies get funds. If you buy a company's stock, what you are is a part owner of the firm. So company issues stock, they're taking on additional partners or owners in the firm. That's equity. So the equity financing of a company is through selling stock, and they generate more owners. They have more partners in the business. Companies can also borrow money, that's debt. They can take out a loan, or they can sell bonds, which is basically taking out a loan. So you can go to the bank and get a loan, or you sell bonds and basically borrow money from whoever's buying those bonds. But if you buy a bond, you are lending money to the issuer of the bond. So if you buy an Apple computer bond, you're lending Apple Computer money. If you buy a U.S. government bond, you are lending money to the U.S. government. So what do you have if you have shares of a company's stock? Again, if you have stock, you buy Apple Computer stock, you buy Walmart stock, you are a part owner of the firm, and you get a prorated share of any dividends that the company pays to shareholders. Dividends are just cash payments to shareholders in maybe half or so of companies. I forget the exact percentage there, but half or 60% or so of companies pay dividends to their shareholders. So this just means they pay you a cash payout, typically quarterly, but more on those later. So again, if you buy Walmart stock, you can walk into any Walmart in the country and say, hey, I own this place. Well, but you and millions of other people own a part of Walmart. Bonds, again, are debt instruments. If you buy a bond, you are lending money. The issuer of the bond promises to pay periodic interest and to repay the face value of the bond at some maturity date later on. So the way bonds work is they pay interest on a regular basis, and then later on they make a final interest payment and repay the face value of the bond. More on those later on too. Mutual funds, again, I'm just introducing these. These are some things we're going to spend a good bit more time on later on. But mutual funds, mutual fund is just a company that basically pools money from investors. So like everybody in the class could, if one of us decided to start a mutual fund, everybody in the class could give that particular person or the company they formed cash, and then they would take that pool of funds and then buy a diversified portfolio of securities. All different kinds of securities, but the main types of securities bought by mutual funds are stock and bonds. Now the mutual fund buys those shares, and then if we buy the mutual fund, we buy shares of the mutual fund, we are indirect owners of whatever securities the fund owns. And the fund passes through, if they own stock and the stock in the fund pays dividends, they pass through those payments to the mutual fund shareholders. All same with capital gains and losses. More on that later on. An exchange-traded fund, again, we'll see this when we talk about mutual funds and ETFs, but an exchange-traded fund or ETF is just a fund that trades like a stock. More on what that means later on, but they hold a basket of securities, typically stocks or bonds, but they also hold some different things in there. And most of these ETFs are tracking indexes, so they'll follow a major subset of securities or an overall group of securities. We'll talk about some of those coming up. When you buy and sell these, you have to pay brokerage commissions if there are any. A lot of places have done away with brokerage commissions. The expense ratios on these are generally low. So that means the management isn't charging a lot for to do the buying and selling of the whatever stocks or securities the fund holds. So most of the profit goes to you instead of to a fund manager. And these have some options that mutual funds don't. But again, more on that later. Now here's a quick flash or a quick quiz on stock. If I buy 100 shares of IBM stock right now, I grab my trusty iPhone, log on to my brokerage account, buy some IBM stock. How much of that money will IBM get? Well, this was actually a trick question. IBM is not going to get any of that money. Okay, if you're buying and selling through your broker, you're buying previously issued stock, and that IBM is out of the picture. It's kind of just like if I sell my Chevy Colorado right now, General Motors is not going to get any of that money because they got it when they sold the truck to start with. So same thing goes with stock. Once the stock's originally issued in what is known as the primary market, that's where the company gets the money. Secondary market is where when you buy and sell through your brokerage account, you're dealing in the secondary market. These are previously issued securities, and the company is no longer involved in that process. So here's acronyms for 100. Let's see if you can get this one. I give you a hint there. You can answer this with either an acronym or a short term. What do we call it when securities are originally issued to the public? So the first time securities are issued, that's called an either IPO or initial public offering. So this is where companies get their money up to start with, is through these initial public offerings. Now here you go. Another IPO question. If your broker calls and says, hey, I can get you in on an IPO, what should you do? If you can get in on an IPO, there have been a few exceptions, like Google and Facebook did some different kind of IPOs, although Facebook's didn't turn out so good to start with. But for the general rule is if small investors like us can get in on an IPO, we don't want in on the IPO. The people that are the places that get most of the offerings, initial public offerings, are big institutional players, people with big bucks, say mutual funds and investment banks and such. They get in on these offerings because most of the time they can make a quick profit on them. Not guaranteed, but they generally come out with a fairly good quick profit to take on the risk, because it's a little bit uncertainty what's going to happen when stocks do trade for the first time. So secondary markets, these are where securities are issued, are traded after they're issued. The two biggest secondary markets in the U.S. that deal in stock are the New York Stock Exchange and NASDAQ. So New York Stock Exchange started out with its nice little headquarters in New York and the central location. There is still some activity going on at the central location, a good bit of activity, but a lot of that has moved over to electronic. NASDAQ began and still continues as entirely electronic, so the dealers in that don't have to all be in one location. Well, let's pause right now, and I'll pick up after this and the next part of our investments introduction.